Hey everyone, thank you guys for tuning in to today's episode of the Triple Net Roundtable. We're here back with episode number 2 today, where we're going to be breaking down real deals, real strategies, and real insights in the net lease space. Today's episode is going to be really strong for anyone interested in triple net investing, particularly within the convenience store sector. So today we'll have Steve Lowe, Senior Vice President at SURMOUNT, who brings over 20 plus years of experience in commercial real estate and the net lease space. And so we'll be getting into everything from tenant quality, how to evaluate tenants, how to evaluate triple net lease deals, discussing cap rates, and how investors should really think about risk, value creation, and where opportunities exist in today's market. So for those that are tuning in, thank you guys. Really appreciate all of the support and looking forward to getting this episode out to you guys. It's going to be extremely impactful. Make sure you like and subscribe, and please share with some of your colleagues and friends and family as well. Thank you. All right. Welcome back, everyone, to the Triple Net Roundtable, where we break down real estate deals, real strategies, and real insights in the triple net lease space. Today, I'm joined by Steve Lowe, Senior Vice President at SURMOUNT, who brings over 20 years of experience in the real estate space, as well as with a strong focus in the triple net lease asset class as well. So today we're going to dive into how he evaluates tenant quality, cap rates, and really what's driving value in today's triple net market. So Steve, appreciate you taking the time to join. Let's go ahead and jump right in, man.
Sure, Marcus. Thanks for having me on.
Awesome. So Steve, I understand a little bit of your background. I know we had connected via LinkedIn, but for the listeners out there, could you just walk us through briefly your background and how you got into this particular asset class within the net lease space?
Yeah, I'm actually a pretty recent, I guess I did this recently, like in my career, where I pivoted about 2 years ago. Prior to that, I had been an industrial broker. So I started in 2004 with Marcus and Millichap in Encino, and, came out of training. And then the sales manager at the time said, okay, what product type do you want to do? And I said, apartments. And he said, no. What else? And I said, I don't know, retail. And he said, no. And I said, okay, industrial. And he said, fine, you can do industrial. And the reason for that, Marcus, was just because we had too many people doing the other product types. So, when I started in the business, industrial was not my first choice, but it taught me a lot about other things. So industrial kind of is the connector to all the other different product types, if you think about it. So, it kind of starts with warehousing and last mile distribution and goes from there. And usually industrial is one of the first product types to be built up when there's new development going on in an area. And then the other things kind of fill in around that. And so it's industrial and housing. And so I started off doing industrial, did that for a while, and then pivoted again. This was in the early 2010s. I went to start my own business where I was doing development and construction. So I was a general contractor for about 10 years.
Okay.
And then started off with that, doing residential, and learned a lot about, flipping houses, things like that, but missed commercial real estate. And so I started moving slowly into commercial projects. And after about 3 years, I was doing only commercial. Wow. So started off doing residential, transitioned, and then had the opportunity to come to Scottsdale, where I'm now, and open an office for a different real estate company, and have a team and train junior agents. So I went back into the business in 2020. So I had kind of a roundabout way back into this. And I had sort of an epiphany about 2 years ago, where I realized, hey, I don't necessarily want to keep doing industrial real estate. I think there's a great opportunity in triple net. And the reason why is because what I saw with triple net versus a lot of the industrial properties I've been working on was triple net properties have, for the most part, really good quality tenants in terms of credit. So, the credit won't be an objection if you're selling a 7-Eleven, for example, or, a Valero or something like that. I mean, those tenants have really strong backing. If you've got a property like that versus, say, an industrial building where it's a local tenant and it's mom and pop credit, and maybe they're a really good business, or maybe they've had some issues like the majority of small businesses out there. You just don't know. The other thing that attracted me to triple net properties was the locations. Generally, those are in more high traffic locations, a little more desirable from I guess, you've heard the phrase location, location, location.
Absolutely.
It's all about location with retail real estate, and not so much with industrial. With industrial, it's more about, hey, is it strategically located next to like a highway or, a main a trucking lane, essentially. And those are not always necessarily in the greatest neighborhoods in terms of crime or desirability from owners. So those two things, creditworthiness of tenant and possibly crime, I guess you could say, or desirability of location. Those two things are what sort of pushed me to start looking more at retail. And I had the opportunity to do this at SURMOUNT. And so far it's going well. We can get into some of the deals that I've closed and some of the other things I've been working on recently. But, it's been a good transition. Real estate's real estate.
Yeah.
So,
absolutely.
you're going to encounter the same objections with the owner of a 7-Eleven that you would with the owner of a warehouse building, let's say, or just a small warehouse building with just a local tenant, or even a multi-tenant building.
Mm-hmm.
They have the same woes and whims that drive them to own real estate and occasionally sell the real estate or buy real estate. So it's the same sort of idea.
Awesome. Thank you for that background there,
Sure.
Steve. So when you first got into the business in 2004, right?
Yep.
Like, kind of dig into your background a little bit, right? I'm sure at that time there's a couple different options that you could have pursued, right? At that time, why real estate, and what did you see at that time to make you want to pursue a career in real estate?
It was towards the end of 2003. I had been running a business that I started. I've always been entrepreneurial.
Okay.
So I was running a business that I started. It was an event marketing company where I was going to military and civilian air shows all over the country. So I would go to, the show at Miramar. I'd go to the show at Andrews Air Force Base, or something like that, and I would bring sponsors to those events. And so I had been kind of tired of running that business. I'd been tired of all the travel. I was a little burned out. And I did the show at Nellis Air Force Base in Las Vegas, and I was just done. I was just, because I've been doing so much traveling, and I was just burnt. So I sold my business. I sold what contractual rights I had to another company, and I had to kind of figure out what I was going to do. And so this was like we're fast forwarding now. This is like, let's say mid 2004. And my uncle was a broker with CBRE down in Tucson for decades, many, many years. He was an industrial guy.
Okay.
And I was talking with him. He's always been kind of my mentor. And I was talking with him, and he said, "Why don't you go into real estate?" And I said, "It sounds really boring. Why would I want to do real estate?" Right? Not knowing what I was in for at that point. And so I kind of thought about it, and then got my resume together, talked to a few different local brokerages. I talked to some big shops, and I talked to some smaller boutique firms, and just really liked the vibe at Marcus & Millichap and Encino, and they offered me a position. And so I went into training, and that was July in 2004. And I was on the phones in September.
Oh, awesome. And so, okay, so your background in times like with that event marketing, business that you had, you already had some business savvy and some business chops there before you even got into the business. So I would imagine that a lot of that helped, like understanding, P&L statements, understanding, customer outreach, customer service, that sort of stuff. And even like, prospecting as well. Cause I would imagine a big, day-to-day, responsibility for yours is like generating new business, reaching out to new clients and so forth. So it seems like, would you say that transition was kind of not necessarily easy, but a lot more, what's the word I'm looking for? It's just a more simpler transition for you going from, already being an entrepreneur, having your own business to jumping into the real estate business. Would you agree with that statement, or were there a couple other nuances there that made it a little bit more difficult for you when you first got into it?
I think that definitely helped me.
Yeah.
In terms of having started businesses before, I had been in sales also. Like I worked for CBS Radio down in LA. I worked for them. I was working for a station down there called KFWB. I was in radio sales. So I was selling airtime. So I'd been in sales before. And so that definitely helped me in terms of just how people skills, like how to deal with people. Yeah. Understanding the importance of picking up the phone and prospecting. So those things definitely help me. And I would say that the typical person that's getting started in real estate nowadays is usually going to be somebody right out of college. So it's probably going to be somebody in their early 20s. And for me, like I was 34 when I started in the business, so I was a little older. Mm-hmm. But I think that's getting to be more common nowadays. Mm-hmm. A lot of people that I see that are looking to get in the business these days are more seasoned and more in like, let's say their 30s, late 30s even. I see that more commonly nowadays. But, in my case, I had other businesses, and so it definitely helped me.
Yeah.
And the work ethic was there, and the entrepreneurial experience was there. So those things for sure helped me.
Absolutely. Absolutely there. Man. And it's, that's actually something that I've starting to see as well on my side of the house. One of my buddies, he's a good friend of mine. And I know him through a men's Bible study group. He just got into the commercial real estate space, right? And he's around the same age as me. So I just turned 30 a few months ago, right? And so I'm starting to see, quite a few other folks get into the space, not necessarily just out of college, but late in their careers where they, decided to make a career change and everything, like that. So that's great to hear, man. Were you married at the time when you decided to make that transition, that career change? And if so, like, what was that conversation like with the significant other there?
Yeah, I was married at the time. I one thing that I think she knew about me was if I say I'm going to do something, I just go do it.
Awesome.
And it's really hard to deter me from that. I can be very stubborn and determined when I want to be. So, I just said, hey, this is what I want to do. It's going to involve me commuting because at the time I was living in Ventura. So commuting from Ventura to Encino, it was sometimes if I left at like 5:30 in the morning, it would take me an hour to get to work. And if I left like during heavy traffic, it would take 2.5 hours. So I had to make sure that she was good with me. Well, two things. I had to make sure that she was good with the commute, but also the fact that there was no regular paycheck. But she was kind of used to that because, running your own business, there's no regular paychecks in that anyway.
Right,
so,
right.
And I'd been able to sort of make it work for a number of years before that anyway. So there was that trust factor. So yeah, it was, there was definitely a discussion that happened ahead of time, but it was also kind of like, hey, I really want to do this. And it's going to be a big commitment, but it'll be worth it.
Absolutely. Absolutely. And then you already had a track record of, being relentless, like you said, being resilient and being able to run a successful business as well. So I'm sure that definitely eased the conversation is also, but switching focus here more so to what you're doing today. And I know you're doing a lot of work on the convenience side of the house when it comes to, the triple net, space there. From your perspective, why is that particular asset class, specifically with these, convenience stores, very attractive right now to investors?
Well, it's the thing I mentioned before about credit.
Yeah.
I mean, if you look at the credit worthiness of, say, even like the top 4 convenience store concepts. Okay. So if you look at 7-Eleven, Circle K, Maverick, AM, PM, you're looking at those type of tenants. I mean, there's really strong credit backing those tenants. 7-Eleven in particular. I mean, like they're really solid investments. That's why they trade for really low cap rates because, in exchange for dealing with a tenant that has the capability to weather ups and downs in the market. And once they get established in a location, they're usually there for a very long time. And same thing with Circle K. I mean, they have really strong credit. I mean, like I've recently looked at some Circle K deals where the tenant's been there for 30 plus years in that location. So, I mean, it's a very safe, solid investment. And that's what, and it depends too, Marcus, on the type of investor you're talking to.
Right.
Some investors, they don't want they would call them coupon clipper type investments where, you have a little bit less return, but it's safe. They would prefer something that's less stable. Investors that buy these type of investments, they're looking for that stability. They're okay with a lower cap rate, and getting less yield out of their investments in exchange for it being safe, as opposed to a multi-tenant investment somewhere. Let's say it's a multi-tenant industrial investment and it's in kind of a shaky part of town in terms of crime. Something like that, you're going to have a lot more turnover and there's a lot more hands-on and a lot more expense in leasing commissions and tenant improvement allowances and things like that. Not really the issue with a 7-Eleven because a tenant like that's going to pay for literally everything. That's why we call it an absolute net lease, right? Because the tenant pays for absolutely everything.
Absolutely. Okay. Awesome. So yeah, so within this, this particular space, right? So you have, in terms of profile of client, right? It depends on the credit rating of the client as well. And then of course, always location, right? And then in addition to that, I would assume, the lease as well plays a part in it too, right? So if you have, whether you're coming into an investment or a 7-Eleven that has maybe like 5 years left on their lease versus one that has 20 years left on their lease, and so that could obviously impact cap rates as well, in addition to like the risk of the asset, also, from my understanding also. But, okay, great. That's
right.
Yeah, absolutely.
That's right. I mean, if you look at, and it also affects financing. So if you're trying to get fixed rate financing, for example,
right,
like a bank is going to look at the lease and say, well, how many years are left? And if you say, well, I have 3 years left and you want a 10-year term on the loan, they're not going to give it to you. But if you say, I've got 10 years of term left, then the terms from the bank are going to be more favorable because they're going to look at that as less risky. So they might give you some terms that you wouldn't otherwise get. They might say, okay, fine, no variable rate interest on the finance. We'll give you fixed rate because you've got 10 years of term. And then you're going to pay more for that because you've got more term on the lease. So that means correspondingly, the cap rate's going to go down.
Right.
So you pay more for the asset, but you're getting better financing. So it's all kind of a trade-off.
Absolutely. I could imagine for a lot of investors, from, the folks that I've talked to, that are investing in this space, they start off, in residential, whether it's, flipping single family houses and then, move up to multi-family, apartment buildings of some sort. Right. And then ultimately they get tired of the 3 T's, you got the toilets, trash and tenants, and then, right, and then they move over to this net lease space where it's essentially, in some cases, depending on the lease itself, it can be mailbox money, right? And then it's, less risk. And then you have those high, creditworthy tenants as well, like a 7-Eleven or like a Circle K, that have been around for years, and are able to, pay these rents on time. And then, over the course of a lease as well. So that's a great to hear there, Steve. So I know you'd mentioned, a recent, deal that we can, potentially walk through here. Can you walk us through something that you recently closed, whether it's, Circle K, 7-Eleven, any of those recent deals that you can, walk us through with the audience?
Yeah, sure. Without getting too specific,
Absolutely.
but So there is a new construction 7-Eleven in northern Idaho that one of my clients was really interested in. And so he and I had been talking about this deal for a little bit. And, a few things had to happen on his end. Okay. So he's a private investor. He's got this, I should say now, because he sold it, but he had this property that had been in his family for a long time. It was a lake house in Washington. It was on, it's some really desirable real estate. I mean, this is a somewhat rundown house in the sense that nothing had been done in that place for years and years, right? Mm-hmm. But the real estate was really, really good value. So he ended up trading out of that asset and, put it on the market. Originally he wanted, I think, 10 million for it. And, the market just wasn't there because a few different factors, but a lot had to happen for him to get a quick offer in time. Well, let me back up here. So what we did was we put the 7-Eleven under contract
okay.
and then had to get a deal in place for his lake house while we had the 7-Eleven under contract.
Yeah. Okay.
So
gotcha.
Knowing that, okay. So, we put the 7-Eleven under contract at a good cap rate. Okay. It was like a mid 5 cap rate for a new construction 7-Eleven. That's a pretty strong acquisition price from the buy side. On the other side of this, financing this deal was the sale of his lake house. And the lake house was going to essentially finance about 90% of the deal, the proceeds. So we had to have a buyer in place, and we had to be confident that they were going to close it all cash within a certain period of time. So there are a lot of things that had to happen. We had to really jump through a very small hoop and make sure that this was done. And so he brought in a local residential broker that had a lot of experience working in this area. And, luckily enough, we found a buyer and we were able to get this deal closed all cash within a very short period of time, able to finance the deal. And, it's a new construction 7-Eleven, like I said, northern Idaho.
Okay.
And, really strong cap rate, really strong fundamentals. We financed only about $1.1 million and just kind of bridged the gap. So the bank was like, we had multiple banks offering financing on this because it was such a strong deal. 7-Eleven is a tenant. Buyers putting down $8 million in cash, on a $9.5 million deal. So, it was a very strong deal from the fundamental standpoint. So getting finance was no problem. And our capital markets team at SURMOUNT did the financing and did a great job. And we're able to find a couple of different banks to source for this, but we ended up going with Cogent Bank, and they're really a really good finance partner. So, we were able to get this deal done, but a few things had to happen because if there was no buyer for the house, there's no funds to buy the 7-Eleven. Right. And then the other thing was, and this is an accounting thing, Marcus, but the other thing was, the idea of getting some depreciation out of it, accelerated depreciation schedule to offset some of his gains. That's where having a good accountant really helped a lot. And so, my client had this, accountant he's been working with for, close to 30 years, and the accountant's really good. So, all these things kind of had to fall into place, and they did. And so we were in a fortunate position to be able to pull this off. But my client's ecstatic. He owns other 7-Elevens and a few other different concepts. He's got Starbucks, Dutch Bros, a few different properties that he owns that, he's comfortable with coupon clipper type investments, right? And the reason is because he's at a stage in life where he doesn't want to put a lot of work into a property. He's in his mid 70s and he's comfortable with just getting a good return and knowing the money's going to be there every month. And so that's what I mean by when I say you have to know who you're talking to in terms of your audience, your buyer, your prospective buyer for a property. Because if you have somebody who's looking for a value add or opportunistic type investment, they're not going to really find that in a 7-Eleven or a Circle K. But if they're comfortable with, hey, I set it and forget it. I buy this property. I know, once the client's, the tenant's in place, I know it's automatic.
Awesome. Yeah. Okay. Yeah. So that seems like you guys were in a time crunch, because it sounds like with the offer, when you guys put that 7-Eleven under contract, it seems like you guys maybe put some sort of contingency in place, like, hey, this deal here is contingent on the sale of this lake house that your client had there, and so okay, yeah.
No.
Yeah. Oh, no. Okay.
No contingency. So this is how we structured the deal. We structured the deal where we asked for a little bit more time on the due diligence. And, and I made it clear, like I wasn't hiding anything, from the seller's broker. I just said, look, here's the deal. Here's what has to happen in order for us to close this transaction. We feel good about it. We feel strongly that a buyer is going to step forward. But if for some reason they don't, he doesn't have the funds just to write you a check for $8 million and then get the rest of it financed, right? Mm-hmm. So I was really straightforward about it. I just said, here's what has to happen, but you need to give us a little more time to get our due diligence done. And so, they were agreeable to it. And I find it's better when you go into a transaction with somebody, it's better just to lay all your cards out on the table, good, bad, whatever, and just say, here's what it is, and that way you move forward and there's no surprises, because nothing will destroy trust like surprise or something that you hid 100%. From another person in a transaction just to try to make yourself look better or try to sort of gerrymander the outcome into something you want by not being completely straightforward about it. You have to be straightforward. You have to tell them what the deal is from the get-go.
100%. Absolutely. And you had mentioned the word due diligence there, Steve. So yep. I want to dive into that a little bit more, because I could imagine with a real estate or an asset class where it's a convenience store, right? So what type of due diligence yep. really goes into, purchasing in a asset of that asset class there?
Yeah, well, with new construction, there's a lot of things that go into it. There's, without getting into too much detail, Marcus, because I don't want to bore the audience too much, but, let's just say, you don't have to worry about the creditworthiness of the tenant so much. Obviously, you look at those things, but what you want to look at is you really want to pay close attention to the lease, because the value in this deal is the lease. This is essentially a lease that is bonded by real estate. So the real estate itself, if you look at the price per square foot and the rent per square foot, over $107 a square foot for the rent and over $1,900 a square foot for the purchase of the real estate. If you we're just going to buy this building vacant, it wouldn't be worth anywhere near that. But so the value's in the lease. Mm-hmm. So you have to pay particular close attention to what's in the lease. Now, in this case, my client is an attorney also. So, he had a little bit more experience reviewing contracts and looking for nuances and any potential things that might be hidden in the contract that could potentially cause problems. Mm-hmm. But, in my case, also having reviewed numerous 7-Eleven leases, you get a feel for different concepts and how they structure their leases. So that's one big advantage of doing triple net properties versus industrial. Industrial, they're all different. And then in terms of the leases, maybe with industrial, maybe you use an AIR lease form, or maybe, maybe the buyer has their own lease form that they wrote, and then the lawyers on both sides have to review that form. In the case of a 7-Eleven, 7-Eleven legal has a pretty standardized lease that they use for these situations. So you get a feel for it. When you've reviewed a number of them, after a while, you're like, yeah, I know how they do things. I know, for example, like this is not 7-Eleven. Let's say this is like Starbucks or something like that. Yeah. I know, for example, if they're defaulted out of their lease, the most they owe is 2 years of back rent. Okay, something like that. That's just something that Starbucks might put in their lease, for example. But 7-Eleven has their own nuances in terms of what they put in their leases. So you start with review of the lease, and then you have to start with And then you go from there and you go into financing. And then in my client's case, because he put down so much money on the deal, because he was coming out of a trade essentially. So he had to put all the cash into this deal for tax reasons. So you put down $8 million on a $9.5 million purchase, you don't have to worry about financing. That's not really the issue. But once you start putting down less money and then you start realizing, hey, my interest rate's 6.5%, but then the cap rate's 5.5%. So I've got some kind of negative arbitrage there. So you've got to look at that too. So you've got to look at, what's my return actually going to be? So it's really about the lease and the financing. It's not really too much of a concern with, is this tenant going to be around? But then you also look at the location. And if it's new construction, I know 7-Eleven did their homework in terms of this location. Yeah. So I know they look at everything from traffic patterns to how many cars per day. Like they have a certain threshold you have to meet when it comes to a new construction site for 7-Eleven in terms of traffic per day. Like they want a certain number of vehicles per day. Mm-hmm. So if it's just not trafficked enough, it's just not going to make the cut for them. So they won't go to that location. And then they also look at what's in the immediate trade area. 1 mile, 3 miles, 5 miles. They're going to look at what's around there. Are there any other 7-Elevens? Are there Circle Ks? Are there competitors? Things like that.
Okay. So yeah, so that's interesting as well, because, in that scenario, it seems like the 7-Eleven or the tenant itself is already doing that due diligence for you, right? In terms of, hey, what's the traffic pattern? What's the, how many cars are passing by per day, right? What's the median income in the area? What's the competition like, to your point there? So whenever they are, doing new construction or, putting locations in certain areas, they're already doing, a lot of that analysis for you, right? So it can only make sense there, from an investment standpoint. So that's interesting to note there, Steve. So, moving on here, Steve, like what's one trend or shift in the market you're paying close attention to right now in your seat, over the next, 12 to 24 months here?
It usually comes down to financing, and where are interest rates heading. And, those things are tied to a few different metrics in, the capital markets. But we're always looking at the financing because, especially with like a new construction 7-Eleven, all the newer ones are over 4,500 square feet as opposed to the older ones, which are, 2,000, 2,300, something like that. Mm-hmm. So those deals tend to be, let's say, $9 to $10 million. That's kind of in the range of most people are not just buying those cash. So you do have some institutional players that buy 7-Elevens that they could stroke a check for that. Okay. But if you're talking about a private individual, most of those people are not buying those deals with cash. In fact, they're trying to put as little of their cash into it as they can when they're still generating enough of a return. Mm-hmm. So, what I'm paying close attention to is what's going on in the capital markets and interest rates, because those things tend to drive our deals a lot. And then, so in other words, like what kind of interest rate could I get if I was to take this deal to a bank? And, how much financing and how much loan to value can I get out of it and what terms? Those things are really important. And then, I guess just consumer sentiments is the other thing. I was just looking at, a few things this morning before we talked, mm-hmm. About, the direction that convenience store space is going with regards to like Tesla chargers and things like that. That shift in behavior from, I've got to go to the gas station to get gas. And then while I'm there, I'll also go to the C-store, because that's really where the money is with these investments. Like they don't make very much money from the gas. Right. They make all their money from the C-store portion. Okay. Mm-hmm. So, as a quick example of that, when I was a general contractor, one of my projects was a Marathon gas station. I took an old Union 76 and I gutted everything. I even pulled out the tanks And, we went with new fiberglass tanks because they had these old stainless steel tanks. So I had some environmental stuff to do there. But I added on to this kind of framework. I added a 2,400 square foot C-store. And then we had 12 fuel positions. At the time, there was no Tesla. So we didn't do an EV charging station or anything like that.
Right.
But the thing that the owner told me was he made almost no money from the gas. All his money was made in the C-store. That's why he wanted to get as much C-store square footage as possible. And so that really sort of helped prepare me for an investment like a 7-Eleven or Circle K or a convenience store space, where you've got your fuel stations. You've got your Tesla charging stations at a lot of these. Yeah. So I'm looking at consumer sentiment. I'm looking long term. Okay. This is not short term.
Right.
But I'm looking at that and I'm seeing how does that affect the tenant? Because that's the one thing about retail is consumer sentiment shifts heavily, then it drastically affects all the locations that particular concept has. So, you've got to pay close attention to that. And, what type of competition is in the space? Like, is anybody really competing with 7-Eleven? They're the number one convenience store concept in the world. Is anybody competing with them? Well, a few are. Circle K, Maverick is another one. Maverick is more rural than Circle K. But so there's a few different ones. And then there are some other big box concepts that are starting to compete. Walmart's got Walmart Fuel, and Walmart is doing, and Amazon's got Amazon Go. So there's a few different things that are coming into the space. I try to stay on top of those trends and just kind of study my market a little bit. And those things also help my owner conversations. My client who bought the 7-Eleven in northern Idaho. He's got another 7-Eleven in Washington State. And so the concern there, this is a smaller format 7-Eleven. So the concern there is eventually, does 7-Eleven start phasing those out? Because they did that recently. They closed a number of underperforming stores and then opened some newer locations. Like we had 3 that opened in 2025 in Arizona, for example, 3 new construction 7-Elevens. So, and that hadn't been the case for a number of years. Like I couldn't tell you how many years, probably at least 10 years. So, but having said that, I think I just try to pay attention to what's going on in the space, what's going on with consumer patterns, behaviors, and then financing. Those things are really important. The other thing you mentioned about 7-Eleven's done the due diligence in terms of, the local trade area and traffic patterns and all that. You bet they have.
Yeah, absolutely. Yeah. And that's an interesting thing to note as well, because with 7-Elevens, right, they're not all corporately owned, right? So you do have a franchisee component to it as well, if I'm not mistaken there. So how does that impact certain deals, whether it's, a corporately owned 7-Eleven versus a franchisee owned 7-Eleven?
Big impact on credit, because we're talking about a corporate 7-Eleven versus something that's owned by a franchisee. Right. There's a big difference in terms of credit, because now we're talking about essentially a conglomerate of different properties that are owned by one entity. And now you've got to really study their credit. But in the case of 7-Eleven corporate, they're publicly traded. So you then just look at their S&P rating and you can look at their quarterly reports. And those are things that those buyers are going to pay close attention to. But yeah, we're talking about a franchisee. That's very different. So now you've got to look at how many units does a franchisee have and what's their credit like. And then you have to really study and take a look at their books and hope that, you're getting really actionable, good information.
So it seems like a little bit more due diligence involved, potentially a little bit more risk, kind of depending on how their books are set up versus with the corporate, corporately owned. It's all more streamlined based for you. Okay, cool, man. So do you invest personally within the triple net lease space, or even if it's residential, do you do some investing on that side of the house as well?
No, I don't do any residential investing. I am part of a family office. Our family office is based in Tucson. We've got several properties down there that we're invested in with partners. Few different things. We've got industrial, we've got shopping center, we've got retail, like standalone, single tenant, triple net retail. And I'll give you kind of like a story of one of those properties. So we own a Big Lots, and I don't know if you what happened to Big Lots, but Big Lots essentially went out of business. Yep. They folded up. Mm-hmm. And so we found out that they were folding up because we got a letter in the mail that said, "Hey, we're closing." We have partners in that deal. One of our partners has been trying to find a tenant for that building for a while. And it just happens, right? I mean, like I said, consumer sentiment, I guess Big Lots just wasn't all that popular with consumers, and, the business format just didn't really work. So, trying to find another tenant to fit that space has been a challenge. And, so yes, I'm involved in that. Although, not directly, the head of our family office handles those decisions. Obviously I weigh in when appropriate, and I give my opinion on things. And so we kind of go from there. But so yes, I practice what I preach.
Absolutely. That only makes sense, right? And I say that because I'm a licensed agent down here in Atlanta, mm-hmm. and I do some residential investing as well, right? And working with a lot of investors, it helps them, particularly when you have someone that's already in the space or already has their boots on the ground, sort of say there, but then also is doing some investing on their side of the house, so they can see you can see the market trends, what's going on in certain areas, areas to stay away from, or areas that are, trending on the up, right? So that's interesting to note there. And then as far as, for some of the listeners out there, whether they are, private investors, or they're, thinking about selling their current property and doing like a 1031 exchange of some sort, if they want to get started within this, triple net asset class, this commercial asset class here, what would be the first step that they should take?
A couple of things on that. I always advise people to be very careful, especially when they're first getting into a particular product type. I have a quick story on this. This is a few years ago when I was still actively doing industrial. So I had a client that owned an apartment building in Scottsdale. I think it was 24 units. And, we were talking, one of my, so I had a couple of different junior agents that I was mentoring. One of them brought this deal to me and said, I talked to this guy. He's got a 24 unit building in Scottsdale. He might want to sell it. Let's go meet with him. So met with him and took a look at his books. And I remember the phone conversation I had with him before setting up the meeting. I was like, well, what are you netting on the apartment building every year? He goes, I make about $11,000. And I said, oh, a month? He goes, no, a year. And I said, you're making $11,000 a year on an apartment building? I was like, what's wrong with this picture? So I met with him. I looked at his books. We kind of sat together and I looked at everything. And I just realized, he had so many expenses and partners, and he had also so many capital expenses because he was replacing HVAC units. And these are things that, and property taxes and everything else. And these are things that the tenants were not reimbursing him for, because that's the type of investment he was
mm-hmm.
in. So I said, I'll tell you what we're going to do. I said, I propose we sell this building and we trade you out of this building and into a triple net, it's actually absolute net lease, but a triple net leased industrial investment, multi-tenant project that I had on the market. This is in Central Phoenix. Had a few different, I think it had 5 tenants, but it was all triple net. And the good part about that was tenants are reimbursing for property taxes, insurance. Tenants are responsible for their own upkeep and maintenance of the inside. And the landlord is responsible for things like roof, structure, parking lot. Okay. So things that are certainly a lot better than what you're seeing in multifamily. So I traded him out of that apartment building and into the industrial project. And he went from making $11,000 a year to making $164,000 a year.
Wow.
So by the one trade. But it took a leap of faith on his part because he had never owned an industrial building. And so, after that, he bought 3 more industrial buildings and started trading out of all of his multifamily buildings. And I think he's at a stage now where he's ready to start moving into something that even requires less management than the industrial projects do. And that is Triple Net. Mm-hmm. And that's because he's at a stage of life where he's got a successful career. He's an attorney, He's got a young family. He needs to spend more of his time at home with his family when he's not working. And he's not really going to get that from an industrial building where he's got to worry about things. Like, I remember talking to him one day and he was like trying to save a few bucks, and he was painting a vacant suite that tenant had just vacated, and he was painting it himself. And I was like, see, this is what I'm talking about.
Yeah.
I was like, this is why you need to get into Triple Net, because otherwise you could be at home with your family right now instead of painting, on a Saturday. Mm-hmm. So in Phoenix in July, right? So, you got to leave the HVAC off because you don't want to take the fumes. You don't want to circulate the fumes through the HVAC system. So you got to leave, and all the dust from the sanding, right? Mm-hmm. So you got to leave everything off. So it was really hot as blazes in there. So, but to give you some ideas, so to transition out of that and into something that you're not familiar with, if you've never bought a triple net or an absolute net lease property before with these type of tenants, I think it helps to have somebody who's experienced guiding that decision, somebody that you trust. But also, it would be good to co-invest with somebody that you trust who's done it before, who knows the pitfalls and can kind of guide you through that minefield of mistakes you're going to make. Because, mistakes are a great teacher, but they're also expensive. Mm-hmm. So, just try to invest with somebody that already owns these type of properties. So, and that can be through a few different avenues. It can be through a DST fund. It can be through a tenant in common situation, a TIC fund or something like that. Right. So I would suggest do your homework, but understand what you want to get out of the investment. So if it's, hey, I want to get more of my time back. Okay, you're going to sacrifice some return maybe, but you'll have peace of mind and you'll get more of your time back. What's your time worth?
Absolutely. Yeah, absolutely. Yeah, and that's the, that's the ultimate question there, especially, within this particular space. Cause right, like you said, like the returns are a little bit lower, but at the end of the day, it's peace of mind that you're getting, right? You're not having to deal. You don't have to paint, after, a tenant vacates. You don't have to worry about any maintenance, kind of depending on the lease there, whether it's, triple net versus, double net or whatever the case may be. And that, one of the things that really, I would say, attracts not only myself to this asset class, but I'm sure a bunch of investors out there, as well, that may be on the residential side, that may be looking for something that's, a little bit more hands off, right? Or less, more hands off, right? And so, Steve, I know we've been talking for quite some time here, and I don't want to, prevent you from enjoying the rest of your day here, brother. But as we, wrap this up, the one question that I always like to ask my guests is, what's the best advice you've received from a mentor related to, business or related to real estate? Like, what is that advice, that best advice that you say you received from a mentor over time?
Oh my, so many different mentors I've had in the business. I've been really, really lucky in that I've had some great people advising me. And sometimes I've been too stubborn to really pay attention to that advice, and I just do what I want to do anyway. But I would say when I've stopped and I've listened to the advice that I've gotten, I can't think of anything off the top of my head I would say is the best, but there's always these little nuggets of wisdom that you get. Mm-hmm. I would say one of the best pieces of advice I got was from my uncle who kind of pushed me to go into real estate in the first place. And he had really got me to look at this business as, it's entrepreneurial. Kind of at the time, I'd been an entrepreneur. I think I mentioned I was running my event marketing business, right?
Yep.
So I'd already been an entrepreneur. But, I think that perspective is important. So when I looked at the business when I was starting out, I realized it was entrepreneurial. I could really sort of make my own destiny if I worked hard enough at it. But it could also help people. I could help people with their investments. I mean, that's the number one thing, I guess, is just remember that you're not dealing with numbers on a balance sheet. You're dealing with people.
Yeah, 100%.
And so I can't attribute this to any one person, but I will say that the number one rule in business is people do business with people they like and trust.
Mm-hmm.
Remember that. Never forget that you're dealing with a person. So, I got this from Oprah Winfrey. Okay. So, Oprah's whole thing about when she would have a guest on her show would be send them away in a limo. Okay. So, and I kind of use this approach in my business. So if I talk to somebody, even if they're rude to me, like, hey, if I'm cold calling somebody, and I still cold call, by the way, I'm not so established in my business where I feel like I don't need to cold call people. I absolutely do. I send out thousands of cold emails. I make hundreds of cold calls. This is like on a weekly basis. So, I'm always out there hunting for deals and wanting to talk to somebody. Okay. Mm-hmm. Even if they're rude to me, I'm always very, very polite. And I always try to leave them in a good place. Even if they're like, hey, Steve, thanks for the call. I'm not looking to do anything right now. And I just say, great. 97% of the people I talk to are in the same position. I appreciate that. What can I do to help? And I offer any type of service I can, not thinking about what am I going to get out of it. Mm-hmm. So the advice would be send them away in a limo. And what I mean by that is if you talk to somebody on the phone and they're really nice, drop a card in the mail, drop a thank you card. I do that all the time. I send probably 20 thank you cards a week. Hey, thanks for talking to me. Here's my card. If I can ever be helpful to you, here's my phone number. Please give me a call. Mm-hmm. So Oprah's advice, I guess, would be send them away in a limo. If you have a guest on your show, treat them well and, make them think positively about you. Hey, look, I said no to Steve, but he was such a cool guy about it. And he was so nice to me that maybe I'll think about him, next time I'm ready to do something, because that's what this business is. It's just a process of being ready when people are ready, not when you're ready, but you have to be ready when they're ready. And so you do that by really ingratiating yourself by remembering the rule. People do business with people they like and trust. And number two, send them away in a limo, treat them well. Mm-hmm. And if you do those things, the rest of it, you can try to be clever and think about what do I say to a person when I get them on the phone. The average person forgets 80% of what they hear anyways. So none of those things really matter. Don't over prepare. Just pick up the phone, call people, talk to them, and remember not to lose your cool. And even if they're rude to you, like some of the crazy things people have said to me on the phone are probably not appropriate material 100%. For the podcast, right? So let's just put it that way, people curse at me and they hang up the phone. That happens, at least once or twice a week. You just catch somebody at the wrong time. But so I would say, Marcus, those two things are important advice. I can't necessarily attribute them to one particular mentor, but they're just things I've learned over the years. So just remember, be the person that they trust and like, and always treat them well. And those things will help you a lot in terms of building your career. Mm-hmm. If you're getting into brokerage.
I love that. I love that there, Steve. Thank you for that, man. Definitely coming with value first. And I resonate with you very much so on the cold calling part, because I do that a lot in my day to day, and I got tons of stories
Yeah.
of of unhappy folks, whenever you call them. But sometimes you just catch them on a bad day, and then you give them a call a couple weeks later, and they're in a completely different mood, and they forget that you actually talked to them a couple weeks ago, and they cursed you out.
Yeah. After you stop recording, I'll tell you some stories.
Okay, absolutely, man.
They're more appropriate for the non-recorded portion of the conversation.
100%. Well, hey, Steve, this has been great, man. Really appreciate you for breaking down, not just the market itself, but also giving us a real look into how these deals actually come together, and so for anyone listening, if you're looking into getting into the net lease or investing or better understand how to evaluate deals, there were a lot of gems that Steve provided in this episode here. Steve, if anyone wants to connect with you or learn more about what you're working on, what's the best way for them to reach out to you?
Yeah, I mean, give me a call. I'm a phone guy, so don't be shy about picking up the phone and calling me. If I'm awake, I answer my phone. So that's just kind of how I do. So yeah, you can give me a call. My office number goes to my cell. So if I'm out of the office, you'll still get me there. It's an easy one to remember, 480-878-0202. So, that's a Scottsdale number, obviously, that 480 area code, 480-878-0202. Shoot me an email. First initial, last name, Lowe at surmount.com. And those are probably the two best ways to get a hold of me.
Awesome. Thank you for that, Steve. And to everyone tuning in, appreciate you for joining us on the Triple Net Roundtable. We'll catch you guys on the next episode. Thank you.
Thanks, Marcus.
Absolutely.